All right. Hello, everyone. Welcome back to the Global Investment Society Insight Series podcast. This is episode 3 with Mr. Richard Brekka. My name is Arman. I'm one of the co-presidents of GIS.
Hi, I'm Cindy.
And thank you so much, Mr. Brekka, for taking the time.
Oh, happy to be here.
Awesome. It'd be wonderful for our listeners who aren't already familiar, but could you please give us an overview of your career path, your journey, and where you are today?
Sure. Um, so I was raised in Southern California. I'm the seventh of 10 children. And I went to high school in LA, a school in Sherman Oaks called the Buckley School. And the reason this part of the story is important is that I grew up with a lot of the Hollywood kids. And I would go over to their houses on the weekend and see these really fabulous mansions. And I started asking the dads how they got it. And the dads all love being asked to talk about themselves. One story in particular kind of stuck with me. The dad said, well, I came up with an idea to do the first national concert tour back in 1970, and I got Elvis Presley to do the tour. And I didn't know Elvis Presley, but I got to Colonel Parker. I spent a year talking to the colonel and eventually convinced him to let me take him out on tour. And it worked really well. And I became a big concert promoter. And he said that was my first big idea. And the thought of a big idea stuck with me. And I said, yeah, but you're not a concert promoter anymore. And he said, no, I'm not. I'm a movie maker. And I said, well, how'd you get into that? And he said, well, my second big idea was an article in the LA Times about a kid being bullied who went to a karate studio to learn how to protect himself. And I took the newspaper article from the LA Times, gave it to a screenwriter and said, write me a screenplay. And that screenplay was Karate Kid. And that got me into being a movie producer. And he said, so there was, in my career, two big ideas, and obviously a lot of hard work and chutzpah and gumption to pull it, to make it all happen. But that kind of got to me. And the fact that when he started with the concert business with Elvis, he needed to give the Colonel Parker $1 million to convince Colonel that he was real, and he got an investor to back him. And I thought back then, well, I don't know if I'm going to have the big idea, but I think if I got educated and worked hard, I could become the guy with the money. And so I went to USC to get a finance degree and to be the guy with the money. And while I was at USC, I had a professor named Arthur Laffer who did supply economics. And Arthur said to me, you need to go to Chicago and get your MBA. And I actually didn't believe he was serious. I thought he was joking. Art was from Chicago. And he said, no, I'm serious. I want you to go to Chicago, get your MBA. I'll write you a recommendation letter. And I said, if you write the letter, I'll go. And he wrote it. I applied. I got accepted. I went to Chicago. And that kind of got me on a journey of headed toward Wall Street. And I graduated from Chicago. I went to work for JP Morgan. And that led me to focusing on investing. And ultimately, through a couple, left turns and right turns, into founding Second Alpha. That's how I got started.
It's amazing. What a journey.
Well, you started your career at JP Morgan and in private equity at CIBC before funding Dolphin Equity Partners and later Second Alpha. What were the biggest takeaway from your time in traditional PE, and what gaps in the market led you to focus on secondary investing specifically?
Sure. So when I went to JP Morgan, you kind of got moved around back then. So you got a lot of different experiences, which is one of the, frankly, the best parts going to work for a big bank like that. One of the first projects I was put on as an associate was trying to buy the Rouge steel plant in Dearborn, Michigan from Ford. And Ford was trying to get it sold because they were just getting rid of a lot of different assets they had. And they're having a hard time selling the Rouge steel plant because it had UAW employees, which is United Auto Workers, which meant that no steel company would buy it because they had the United Steelworkers employees, and it caused a big issue. So it ended up having to be a management buyout. But the problem with Ford was they didn't have a good accounting system, and there's no way of knowing what the steel plant actually made. And so I learned how to make steel almost like a cooking recipe and apply it into a computer and build a steel plant in software, kind of like an Excel model, to replicate the steel process and figure out how to make steel work and whether it made money doing it. And that taught me a lot about understanding the fundamentals of business. And we literally were over in Dearborn, Michigan, asking the accounting department for invoices for the inputs going into steel, and then applying the formulas of how much heat was required and everything that went into making steel, and then modeling the whole thing. It's probably one of my best experiences working there. The other major experience there was buying a styrene plant, and we had to figure out could it make money. And we knew from the guy I worked for had a chart that just showed supply and demand of styrene, and over the years plants had been coming offline, and the supply line and the demand line were pointing right at each other. And we bought the styrene plant. We figured it would generate about 30 million in EBITDA in the first year. Well, the lines connected, and when it's a commodity, the elasticity of demand was vertical until it got up to the replacement cost, which is paper. So styrofoam cups can be replaced by paper cups. And we knew how high that would go. And in the first year we operated that styrene plant, we generated $300 million in cash, which was the purchase price. And so that was a second lesson in terms of, how to look at different businesses. And then the third lesson was a guy came to JP Morgan to get capital. He was buying radio dispatch frequency, which is the spectrum next to cellular, where it was the old push-to-talk radios that taxi cabs used. And he wanted to make a third cellular company. And everybody said it was a crazy idea. But I looked at it and said, it would work if you can get the technology and the product developed and bring it to market. And so we bought the spectrum in the 10 largest cities in the country, and we called the company Nextel. And we took Nextel public. And here's another lesson. Nextel only owned 10 cities. It was trading for $10 a pop per population of the city. But the rest of the country hadn't been bought. So I went out and bought every city in America, and sold them to Nextel. And I buy them for $1, sell them for $7 to Nextel. Nextel got the arbitrage between 7 and 10, and I made 7x on everything I bought. And so those lessons really taught me a lot about how to look at businesses. And I did it at JP Morgan. I did it at CIBC. I went out and started Dolphin Equity, which is venture capital fund. And I did that for 13 years. And then I got the idea of starting Second Alpha. And Second Alpha came from a company the idea came from a company I was backing in Boston called Gomez.com. And in the last year we owned Gomez, I got a call. And I'm going to tell the colloquial version of the story. I got a call from an analyst, a young guy at Bank of America in Charlotte, who said, I have a Gomez stock certificate. And I said, where'd you get it? He said, well, it came in a box that my boss dropped on my desk. And I said, well, where'd the box come from? And he said, well, we bought Fleet Bank, and Fleet Bank bought Bank Boston, and Bank Boston had a venture group. And that's where they originally invested in Gomez. But now it's sitting on my desk, and my boss had asked me to get offers. And I told him, I don't do that. I'm a venture capitalist. And I said, tell me exactly what your boss told you to do. And he said, I've been instructed to empty the box. And I said, well, if that's the instruction, I know what price I'm going to pay. And I offered him the same price I had paid for my Gomez shares 9 years earlier when it was a startup. And he knew it was a terrible offer. And he said, send me a purchase agreement. I'll give it to my boss. I don't think he'll take it, but let's see. And the next day, the purchase agreement came back from B of A, signed with wire instructions. And so I bought the shares, and about 6 months later, we sold Gomez to a company called Dynatrace for 300 million. I made 13 times on my original private venture investment. I put 7 million in to Gomez, and I made 100 million on the sale. But I also made 13 times on my secondary investment and made that in 6 months. The primary investment I put in the venture investment I made at Gomez took 9 years. And that's where the light bulb went off and said, I'd rather make 13 times in 6 months than 13 times in 9 years. And that's where I got the idea to start Second Alpha.
Wow, that's another incredible story that really prompts, I guess, the next stage in your journey. I guess like this is a question that goes back to your origins, which was your entrepreneurial journey within the concert promotion, right? And eventually you started your own business with Second Alpha and you started your venture capital firm. What were some of the redirection back into that entrepreneurial journey and the lessons that you learned from previous firms working at JP Morgan, working at CIBC, and then bringing that to the entrepreneurial side and even investing and allocating money in that way?
I think one of the interesting things was in starting Dolphin Equity. I had been working with a number of venture capitalists who were very successful guys. And I told them I was going out to start my own venture fund. And I was out trying for quite a while, several months, and I had saved up some money to be able to go out and raise the capital. And I thought, it might take 6 months to get to a first closing, which frankly was pretty naive at the time. But I'll never forget, I was in Chicago and I was meeting a friend of mine who was one of the managing partners of a big fund. And I said, I'm running out of cash. I don't think I'll be able to get the fund raised. I think I'm going to have to give up and go find a job. And, the guy said, let's get together tomorrow. I want to talk about this some more. And the next day we sat down at breakfast and he said, I don't want you to give up. I want you to keep trying. And I'm going to help you get across the finish line because I believe in you. And he pulled out of his pocket a check for $50,000 from his own bank account and said, here's a check. This is how much I believe that you can make it and get your fund raised. Only cash it if you absolutely have to. And I would have ran through walls to make sure I got the fund raised and not cash the check. But it gave me the faith and determination that somebody was willing to gamble their own money with nothing in return to get me across the finish line. So I actually did raise the fund and got closed. And I called up that friend and I said, I have the $50,000 check. I never cashed it. What would you like me to do with it? And he said, I'll just tear it up and throw it out. And it's probably the biggest mistake I ever did because I did tear it up. I should have had it framed in lucite as a constant reminder of when you get people that you build relationships during your career, that when the chips are down, that will step up and give you a check and say, don't give up. And that had a huge impact on me and, why I am and where I am today. So
that's awesome. Yeah, that's great. And on that same line, when looking and trying to find those investors, when you co-founded Second Alpha, secondary investments weren't as widely accepted as they were today. What was sort of the initial investor reaction, and how did you position the firm to convince the market that liquidity-driven secondary transactions could be a value add to venture capital's economy?
Yeah, it's interesting. And I think we're still in the early days of this marketplace. When I would go talk to a company and or anybody with associated with a company, if I went to the outside investors, the venture funds, the private equity funds, and say, hey, I'm looking to provide liquidity for shareholders, can you help me, make a connection here? The investors will always say no. We don't want another guy coming in here, and they wouldn't be very supportive. I go to the CFO of a company and say, hey, I can provide liquidity, are there any shareholders I could help? And the CFO would say no. And I'd ask the general counsel and he'd say no. And what I learned is the one guy you talk to is the CEO, because the CEO actually knows what shareholder wants liquidity, because that shareholder, if they've got a liquidity problem, the person they call is the CEO. And when I ask a CEO, does anybody need liquidity? The CEO goes, yeah, there's a guy, and he's been a real pain in my rear because he's been calling, but I don't know how to help him. And that's when I realized, where the path to the answer is. And if you work through the CEO, you'll find out which shareholders have liquidity and you can actually get things done. And it's been really the key to why we've been so successful in doing that. The market needs liquidity. But there was just a general attitude back then when I started that I'm not letting somebody else out until I'm out mentality. And it was pervasive through these companies. The markets really started off where liquidity really started was with LP interests, and funds were formed, big firms like HarborVest, and guys like Fred Maynard, who's one of the founders of secondaries, would provide liquidity to limited partners and buy their LP stakes. So it's a layer above. And that was most of the secondary market for a long time. And then it opened up a little more where GPs could reorganize their fund with the continuation fund and provide liquidity to the limited partners of the funds that way. And that was another avenue. And then the third, which is the newest part of it, is where the actual shareholders of these companies try to get liquidity. But in the shareholder realm, most of that market is still just in the largest companies, SpaceX, Databricks, Stripe, companies like that. 99% of the volume in secondary direct investing is in unicorns, and most of that's in 10 names. So it's just really beginning as a marketplace of getting liquidity to shareholders. It's pretty new.
Still on a topic of unicorns, venture capital, and secondaries, well, VC has historically been focused on primary investment and growth funding. And how do you see secondary markets evolving within the VC space? And I guess, what do you think is driving the increasing demand for the secondary liquidity solutions?
It's really about time. Nobody invests in a company thinking they're going to be there 15 years from now. Everybody invests. I've heard it over and over, companies going to IPO in 5 years. And it's a startup. And it's just not reality. The average age of a company is 11 years. And so you have a lot of investors and a lot of capital tied up. And in the venture funds, generally in the earlier stages, there isn't the avenue to liquidity. I'd probably call it the first 5 or 7 years of a business. And then kind of like 7 to 12 years is really where the growth equity funds are much more active. The companies have gotten bigger and more mature. You do see growth equity funds starting to offer, as part of their solution, a secondary purchase, where they'll make the primary investment and do a growth equity round, and then they may offer to buy some shares at the time. And so you're starting to see growth equity funds get into the business a little bit. But even still today, it's a very small portion of their business. And that just means there's a lot of pent-up demand for liquidity. If you look at the private tech market, it's about $3.5 trillion worth of companies. $2.5 trillion of that is in unicorns. And then there's $1 trillion of companies that are somewhere between 100 million and $1 billion valuation. That market only gets about 1% of the liquidity of secondary volume, even though it's about a third of the market. There's just not that much liquidity in that part of the market.
Very interesting. I think this past summer I worked on a private debt secondary desk, and one of the issues that our team worked on was differentiating our investments between investors who are looking to get out because of distressed sales or because of necessity versus those looking to get out for strategic reallocation. I was wondering how your firm distinguishes between the two, and if there were indicators to figure out which allocations lead to long-term value and getting those 13x in 6 month situations.
Yeah, not as easy as it looks. But we do have a new one that we're likely to make 13 times. In the secondary direct business, so on the equity side, not on the debt side, the sellers, everybody's looking for liquidity. Everybody's been in there too long. What we look for in sellers are the ones who want to sell as little as possible. And this is more on the individual investor side. Venture funds, typically, if they're looking to sell, it's a 15-year-old fund, it's the last asset in the fund, and they just need to get liquidity for the LPs because the LPs are mad at them, that they've kept that fund alive for 15 years and there's only one company left, and they're hanging on for a miracle. But on the individual side, if an individual is looking to sell 100% of what he owns in a company, it's a red flag. We never like those sellers. If a seller is saying, I'm willing to sell 10% or 20% of what I own, but I really want to keep the rest of it because I'm looking forward to the day when the company gets sold or goes public and I get my big payday, that's the perfect seller for us. We like that guy because he believes in the company. And even if he's a founder who's not working anymore at the company, he still wants, he's still holding out for the ultimate exit. And we much rather provide liquidity to those people. We're here, in our minds, we're here to solve a liquidity problem. So, we meet a seller and they're like, I need money to pay for my kids' college. I need money because my wife and I want to buy a house. Those are the kind of sellers that we like to, help them get liquidity. And then they're holding on to the rest of their stock because they really think this is going to be a great company. And for us, that's alignment. And those are the kind of sellers we like to interact with. And then what we find is that there's a lot of them in companies. There's lots of founders and angels and former employees that we can build a position of $15 million making purchases from 15 or 20 different shareholders. So that's what we.
I think you kind of hinted this, unlike traditional primary venture capital deals where valuation is set by the latest funding round, secondary transactions involve pricing companies work without a formal price discovery process. Can you talk about how this second alpha navigate this challenge and what methods do you use to ensure a fair valuation in a market where there's information asymmetry?
Right. Since we're always working through the CEO, we always get lots of information on the company. And then that allows us to do a really thorough valuation analysis. And this is where your business degree from Marshall comes in handy. We will do a discounted cash flow analysis. We will do a comparable analysis of companies similar to the company we're looking at, and we'll do the valuation for that. We'll look at M&A statistics for companies that have sold. And really what we're looking to do when we come up with a valuation is we're looking at what value do we buy at that's going to give us the kind of return we want over the next 3 or 4 years. We're generally underwriting a 3x return in 3 years is what we're looking for. And so the number that comes out of all that analysis probably is not going to match up with the last round of growth equity that the company raised. And so there's generally a material discount to what the last round of financing would have been. We also use the companies generally produce a valuation every year for their stock options. It's called a 409A report. And a 409A report has, a discounted cash flow, an M&A, and a comparable analysis similar to what our analysis is. And that can be indicative of what a common share in a company might be worth. And those are the data points we look at. It's different than, how other funds might look at it, because they may be looking at it from a longer, if you're a primary investor, you may be looking at it from a longer term perspective, or they may be looking at it where their target return isn't as high as ours. And so those are the factors that kind of drive our evaluations.
Got it. Well, you have shared so many cool experiences. Can you maybe share a particular challenging or insightful deal from your career that shaped your approach to investing?
Sure. I mentioned this company, Gomez.com, where the B of A had sold to us. That was an interesting story because it was a .com unicorn at one point. Investment bank had valued it at $500 million. They're going to take it public. They had an S1 on file. And then the .com bubble burst, and a lot of the customers that were customers of Gomez were .coms as well. And when they all ran out of money, Gomez ran out of revenue, and the company imploded. And when I got involved in recapping it, the company only had 900,000 of revenue. They had fired 90% of its employees, and it was a restart. And I restarted the company, and we fired Julio Gomez, the founder. We had a second CEO in there for 2 or 3 years. He started to fail. We fired him. We brought in a third CEO. That CEO was just wrecking the place, and we fired that CEO. And I made probably the biggest career mistake in my life. I got up from a board meeting in Boston and went to the bathroom. And while I was in the bathroom, the board's talking about the fact that there's no CEO to run the company, and nobody's sure what we should do. Well, their solution was that since I wasn't in the room, that they should nominate me as CEO, and that I should be the one who worry about figuring out how to run the company and keep it from failing. And so I came out of the bathroom, and the board said, "We have great news. We've solved the CEO problem. We've nominated and approved, and we got minutes here that have elected you as CEO. Good luck. Let us know how it goes." And those guys, a bunch of wimps, got up and ran for the elevator before I could stop them. And so I ended up running Gomez for about a year and running Dolphin Equity in New York City, and I was commuting between the two. And it was a great learning experience because I had to figure out how to turn this company around and make money doing it. And so it was a software as a service business model, but they had a process where when they sold the service, they'd send a bill, and they bill monthly in arrears. And we're growing, but we're constantly running out of cash. So I turned the business around and said, I'm going to bill all the customers annually in advance. And then all the cash started coming in ahead of time. And that allowed for us to fund the business and grow it. And I ran the business for about a year. But I also knew I'm not a CEO. I've never done it before. It was the only time I ever did it. And I went out and found a really, really great CEO. And I described what the CEO I hired, he was like one of the great coaches in football. He came in with a playbook. He knew exactly what he was going to do. I used to refer to this as a Belichick story, but it turned out it wasn't the playbook, it was the quarterback, Brady. But anyway, I brought this guy in, and he built the business, and we ultimately sold it to Dynatrace, and we made 13 times. And I also did the sale, the purchase from B of A, where we made 13 times. But I spent 9 years doing that company. And when we sold the company, a paper in Boston called up and said, "We just read about Gomez selling to Dynatrace. We've never even heard of this company. And frankly, we don't know you. You're not a Boston VC. So we want to do a story about the overnight success of Gomez." And I said, "That's a great story." I said, "The overnight success took 9 years. How about a story about 5 CEOs in a bathroom? That'd be a more entertaining story." So they didn't publish the bathroom story. But that deal taught me a tremendous amount and kind of led to what I'm doing today.
It's amazing. Every story that you tell, I can see all the skills and experience that you've gotten from it. And it seems like it all accumulates into the firm that you run today and the investment process you run and the success you've had. For young professionals that want to develop those skill sets and those experiences, what would you recommend they either partake in, or what can they do to develop those skills if they are interested in secondaries?
One of the things that I talk about is getting to know the CEO. And what you learn in this business is, and I hate to say this, but I went to Chicago to get my MBA, so it's okay. I would not have gotten an MBA other than for the fact I wanted to go to Wall Street. I wanted to go to investment banking, and an MBA was required. I would get a slightly different degree. I get a degree in psychology, because the most important thing in business is to understand the person across from you and what's driving them, whether it's the CEO and what he's trying to do to build the business, or it's the shareholder who needs liquidity. And if you really work to understand them, you're going to have a successful career. I made the mistake early in my career as a venture capitalist of a winner-take-all approach to everything. Never left a penny on the table, negotiated extremely hard with wherever I was making investments. And it wasn't a smart move in the long run. I learned it early on because I had a very successful, well-known VC say to me, he said, you could be one of the greats, but you won't be if you keep taking every dime on the table. You have to learn how to make a win-win situation. And that's one of the lessons I've taken away when I look to do a transaction. Very often when I'm buying from a selling shareholder, I tell them only sell what you have to. I'm gonna have a price, it's a discount. But if you only have to sell 10% of your stock, only sell 10%. And I've had people look at me like I have three heads and going, are you trying to talk me out of selling my shares? And I said, not trying to talk you out of it. I'm trying to minimize it because I want you to end up with the most money you possibly can have. And the funny thing is I've had some situations with a founder where I provided them liquidity, allowed them to buy a house. And his wife called me and said, I want to thank you. You just changed our life. And then the CEO or the founder called me and said, why did you get the phone call? I spent the last 10 years building the company. And I said, well, you did, and congratulations, you did a great job. But my name was on the check. So, so, you end up working through things, but it's really important to understand what's motivating people. And if you focus on that, you can get a lot of great things done.
That makes a lot of sense. Taking psychology degree or understanding what the other side of the table is thinking. But shifting topic back to Second Alpha, what excites you the most about the future of your firm and the broadened secondaries market? And how do you see the firm evolving in, I guess, the next decade?
Yeah, wow. We're in the early innings. The secondary direct is, focused on a handful of names that are unicorns. There are 4,000 companies that in our target market that are of scale. There's about 700 or 800 that are unicorns out of that. So there's a big marketplace, and there really isn't that many players in this market solving this problem. Our challenge is how do we do more? How do we do it efficiently? How do we keep the discipline that we've had that has led to all the success we've had, and be able to grow with this marketplace? So we're looking at a lot of different strategic alternatives to how we build this business, but I think the best is in front of us. I think that we found basically a white space in the investing landscape that others were not addressing. And even today, and despite me talking a lot publicly about this, they're all still focused on the unicorns. And that just makes a big market for us to go after. So I think there's a lot of exciting times ahead of us here.
Awesome. It's all very exciting, and we want to thank you so much for all the advice and experiences that you shared. Before we end off, we'd love to ask for any general advice that you have for young professionals and students like Cindy and myself who are listening, want to break into the finance industry or want to learn more about this space. What would you give advice to them for?
Yeah, I was just talking to one of your classmates. You know, I think getting experience, I went to JP Morgan. I got a lot of experience in a lot of different ways. I wouldn't stay there very long. I think, you get 2 or 3 years experience in a big bank and you can see a lot of different things. I think that's really helpful. On the flip side, when I was starting my career, I didn't know about venture capital. I certainly didn't know about secondaries. I don't think they even existed. Or buyout funds, or even hedge funds. I knew about investment banking and regular banking, and that's kind of where I thought the starting point could be. So my advice is try to figure out what all the alternatives are. And then if you're not sure, try to get enough experience that you can pivot in your career, because you're not going to start in the job that you're going to end in, or and maybe not even in the industry that you're going to end in. But you want to get as much experience as you can early on, and don't worry about the money. The money will come later. Easy for me to say, right? But you try to just get the experience, and I think that's the real key.
Amazing. Thank you so much, Mr. Brekka. We really enjoyed speaking with you and wish you all the success with Second Alpha. And thank you again for taking the time.
All righty. Nice talking to you. Take care.